gold and silver. We expected, because the COMEX and the other exchanges here are running out of physical silver, so they really need to strangle activity, especially the kind of activity where people are standing for delivery on futures contracts. And so this is a chance sent by heaven for them to lower the price of silver to the point where it's not an issue. They're not going to be drained dry in the short run and then have to default. Historically, everybody piles into gold, and we'll probably have to go back to a gold standard. We'll have a currency reset that is possibly a gold standard, or at least will involve gold in some way. And when that happens, it has to be at a much higher price. There's gold's fundamentals. It's got to go up to $15,000 or $20,000 an ounce to be able to make the next global currency system possible.
Concerns about tightening physical supply on the COMEX and other major exchanges are reigniting debate about gold and silver markets. Analysts argue that if more investors stand for physical delivery, exchanges may be forced to suppress volatility to avoid liquidity stress. Financial author John Rubino suggests that historically, monetary instability drives capital into gold, potentially paving the way for a currency reset anchored to hard assets. If a new global system incorporates gold backing, prices could require significant revaluation, possibly reaching $15,000 to $20,000 per ounce, to support sovereign balance sheets and restore long-term monetary confidence. Now, we present the clips from John Rubino's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The price of silver to the point where it's not an issue. They're not going to be drained dry in the short run and then have to default. So all of that stuff is going on. And most of it will probably reverse out once the Asian traders come back in, because they're basically buying physical for industrial uses. And, the solar panel guys still need the silver they need. The electric car guys still need it. The world's military industrial complexes out there all need silver for their missiles. And so physical is still going to be in demand. The price pressure will probably be to the upside once China comes back online, and we'll probably forget about this week. It'll just be a squiggle in the context of a long-term bull market. So the question is, should we be bottom fishing here? It's just so hard to call these things, these prices the bottom. I looked at SIL, the big silver miner ETF, thinking maybe I'll grab some cheap shares here, but they're still not cheap. They're double or triple where they were a year ago. So bargain hunting just doesn't feel right at these price levels. So I'm just sitting on the sideline waiting for all this to play out. Sideline where silver goes up and up and up, and all the people on X brag about how well they've done and everything. Well, this is a chance maybe to grab some of those shares that they missed. So I think there's some buying incentive out there right now for people who missed the boat and who want to get back in. And that's probably supporting these shares to an extent. I mean, it won't continue to support these shares if silver keeps dropping. But right now, there's probably a justification on the part of a lot of people right now to pick up some of the shares that they missed at least 20% off, because they missed the 200 or 300% move in a lot of cases, but at least they can buy in when the chart is heading down and maybe get back some of what they lost. I don't know. We'll see. But I think there's the real possibility that that's the case. There are a lot of reasons to expect the silver deficit to grow and to turn into panic buying at some point. And that's the fundamental fact of the silver market. We just don't have enough silver. And there is massive demand for it on the horizon. And historically, that's the kind of thing that leads to big increases in price. So if you stay focused on that and keep dollar cost averaging and using lowball bids to get things as cheaply as possible, then you're okay financially and psychologically, because otherwise these what are going to look like squiggles 2 years from now, but these really massive moves in the moment will drive you crazy. And what you don't want is to be driven insane by your money. Your money should be working for you and should be lessening the stress in your life. But if you try to trade something like silver, try to go in and out, then your stress level just goes through the roof, because silver will kill you, or any kind of highly volatile market. Like if you try to trade in and out of AI stocks, which a lot of people do, a lot of people go in and out of Nvidia and stuff like that. Well, sooner or later, you're going to be driven insane by that, because the stress will just become overwhelming, because you'll be so wrong with so much of your net worth. So just don't do it, Add gradually to these sectors and these commodities that have really good long-term prospects, like copper. The copper story is great. We're going to need, there's one speech that keeps showing up on YouTube where somebody big in the copper space says, we're going to need to find as much copper in the next 18 years as we found it in the previous 3,000 years. And we aren't going to be able to do that. So when you have those kinds of fundamentals in the market, you should be very comfortable just gradually adding to your position. And of course, gold. Gold is obviously something that has phenomenal long-term prospects, because the world is inflating away all the big fiat currencies. And when that happens, historically, everybody piles into gold, and we'll probably have to go back to a gold standard. We'll have a currency reset that is, possibly a gold standard, or at least will involve gold in some way. And when that happens, it has to be at a much higher price. So there's gold's fundamentals. It's got to go up to $15,000 or $20,000 an ounce to be able to make the next global currency system possible. So, same thing with gold. Add gradually. You don't have to play the squiggles. Just buy what you can when you can, and let the fundamentals play out.
Industrial demand is reinforcing the long-term bull case for silver, even as short-term volatility shakes out weak hands. Analysts note that delivery pressures on the COMEX may ease as Asian buyers return, particularly from China, where solar panels, electric vehicles, and military applications drive consumption. Despite pullbacks in mining equities like the global ex-silver miners Etsy fall, deficits could widen, setting up future price spikes. Investors are increasingly favoring dollar cost averaging over trading volatile names such as Nvidia. With copper shortages looming and gold potentially repriced in a currency reset, precious metals remain strategic long-term assets. Let's get back to the interview.
So the industrial users of silver are buying as much as they can at whatever price they have to pay. And that is leading to a lot of commodities, futures contract players who didn't used to stand for delivery to demand physical silver. And the COMEX is being drained dry, although what's happening this week might help them accumulate a little more silver and delay the inevitable. But the time is coming out there when the futures markets, it used to be just places where people gambled without ever expecting to get something as unwieldy as physical metal, as part of the process. Now they're starting to demand physical metal. And that's leading to the possibility of a default. And as you said, if they settle with cash, they'll say that's not a default. They'll say, well, we gave you cash. We gave you the value of the silver, but it will be seen as a default, because if they had the metal, they would hand the metal over. And once that happens, you get the prospect of panic buying out there as people realize that they're out of silver and they need silver. If you're an electric car maker, you need X amount of silver in the coming year to keep your factory running. And so the price of silver becomes irrelevant when you're thinking in terms of availability. So you need this thing that keeps you from shutting down your factory and losing billions and being the laughing stock of the industrial world. So you pay whatever you have to pay. And if we have the metals exchanges start to default, then you have the prospect of that kind of a market. And you've got analysts out there saying, oh, silver $500 an ounce this year, and I would never make that kind of a prediction, because that's a hell of a prediction. But in markets where you have extreme shortage and that turns into panic buying, and you sometimes get crazy pricing. That happened with nickel a lot. And everybody should remember that, because, and I'm pretty sure it was nickel, right? Where it went straight up.
2022.
Okay. Yeah. And so there were a lot of people out there who had long futures contracts in nickel who were rich on paper. They thought they just did the one trade they had to do in their lifetime because nickel went up so much. And then the exchanges just canceled contracts. They just said, this never happened. We're going to give you all your money back. And there were no massive lawsuits, nothing happened in the Supreme Court or anything with that. It just happened. And everybody who was wrong got away with it. So stuff like that, knowing things like that can happen means that we should consider that possibility in commodities markets going forward, because there are quite a few commodities markets where there are potential big shortages out there. Copper is one, silver is another, gold. Who knows? And there are lots of rare earth elements and things like that that trade, but I can't pronounce their names. I have no idea what their fundamentals are, but their fundamentals are probably pretty favorable as we run out of all this stuff. So there's the potential for a lot of action in the futures markets. And, there's no way to know where it starts and what the final result is, but it could be pretty chaotic. And the chaos is probably going to be to the upside. So, it's a thing to pay attention to. It is not a thing to bet your life savings on. You are not that guy who's making big bets on gold out there. So regular people should always be cautious, even when, there's a talking head saying, oh, the COMEX is going to collapse and there's going to be panic buying, like I'm saying right now. Don't take that as a signal to bet your retirement on. Take it as a signal to pay extra attention to that market and make sure that you are represented in it with some high quality stocks and some physical and things like that. But unless you're a professional trader, you don't want to be betting large amounts of money on the collapse of the COMEX or anything like that. You want to be buying a good quality ETF that represents a lot of the silver mine or something like that. And maybe some silver eagles if you can get them or something like that. You want to be looking at physical silver and high quality miners, not in any circumstance futures contracts.
Industrial silver demand is reshaping the futures market as more buyers on the COMEX stand for physical delivery. If exchanges resort to cash settlement, confidence could erode, fueling panic buying and extreme volatility similar to the 2022 spike on the London Metal Exchange nickel market. With electric vehicle, solar, and defense sectors competing for supply, shortages may intensify. Rather than speculate in futures, investors are considering diversified exposure through vehicles like the Global X Silver Miners ETF, or holding physical coins such as American Silver Eagle, focusing on long-term fundamentals over risky leverage. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.